Market is trying to stabilize here after an 8-week losing streak. And my next guest says inflation, not recession, remains the biggest risk for investors. He's sticking with large cap dividend paying stocks. Joining me now is John Augustine, the chief investment officer of Huntington Private Bank. John, welcome. You think dividend payers are going to offer enough inflation protection?
We do. We think consistent earnings, dividends are going to continue to be the way to go. Even though we are seeing some growth come up this week, we still think those dividend indexes, Kelly, if you think about it, some of those dividend indexes are only down 2% this year. That's constructive in the kind of year we're having for stocks.
What about Kraft Heinz, though? I mean, this is one of the big go-to places for dividend payers, and yet consumer staples have had a really rough stretch lately.
Yeah, but that's one of those ones now that's perceived as not consistent. You talked about it yourself. You and Dom saying potentially they can't keep up with inflation. Personally, I got to admit, full disclosure, I'm more of a Kirkland guy. But anyways, with respect to Kraft Heinz, maybe they don't have what it takes to keep up with inflation. Look at Cisco Foods. They're on the other side of that today. We just added that from our equity team. What
else have you been adding here? What stocks are you definitely picking up?
Well, we've been in the REIT sector. So REITs, real estate, we continue to look at as more or less utility infielders. Then the services on the consumer discretionary side, people getting out for services now, the Hiltons, the Booking.coms, et cetera. So what we see is this big shift second half of the year. Energy earnings decline, consumer discretionary led by services increase. That's what our equity team's trying to get ready for.
It's interesting you say real estate is a place you're looking, or REITs, I should say, because you'd seem to have the headwinds of a slowing real estate market and rising rates. Granted, the slowdown seems to be more on the residential side, but explain how they can, compete/do well in this kind of environment.
Yeah, kind of three things that our equity team's looking at. Number one is dividends. We like dividends right now. Number two is an inflation hedge, because as you talked about, some of the commodity prices, energy, just aren't cooperating yet. And then the potential for capital gains out of those stocks. Some of the beaten down stocks, think of Simon Properties. So it's kind of three things we're looking at with respect to REITs.
And finally, give us some names in the other sectors that maybe we talk less about. And where does energy screen for you? I mean, today, those are all of the top names in the S&P 500 trading at record or multi-year or certainly 52-week highs.
Yeah, what our equity team does is they put their energy positions in last year. They've held them. So now with that growth this year, they're overweight. So think of EOG Resources, think of Valero, think of Schlumberger, think of Chevron and Exxon. Those are the plays they're doing. They're trying to be broad across the energy sector with their representation. They're holding those positions, not necessarily adding to them right now. So those are some of the areas we're looking at.
All right, John, we will leave it there. Thank you so much for your clarity today. Appreciate it.
Thanks.
John Augustine with Huntington Private Bank.